Hello everyone and welcome. Given the recent Bank of England base rate announcement and their decision to hold the rate, I thought it'd be a great opportunity to bring together three experts from within our industry and discuss their thoughts on what this means for the market. So let's get straight into the questions. Paul, I'm going to come to you first. So as we know recently, Bank of England held the base rate at 5.25. How do you think this is going to impact the market?
Well, I think it was good news for a start, and I think it was something that was able to happen after the inflation figures fell as they did, which wasn't the expectation of the market. And then the base rate being held again wasn't the consensus position prior to the inflation figures. I think it quickly became so after the inflation figures. I think it's a good news story for consumers. Whether this means that the base rate can fall, I think, is somewhat in doubt.
Okay.
I think the swap rate position and what the governor said yesterday indicates an extended period. It may stay at 5.25, but there has to be some possibility that the next MPC committee, which I think is the first week in November, could see a rise. I think we haven't built up any kind of trend. The trend has been for an upward increase in the base rate, and I believe I'm right in saying there was 14 increases in a row. So now we've had our first hold. It may not be a signal that things are going to move downwards. I think they need to have a much stronger control on inflation. We're still over 6% and the Bank of England's target's 2%. And I think they want to hold this for as long as possible to take the demand out of the economy and to reduce the inflationary measures, which is their sort of standard role. So I think we may have to get used to a base rate at this level. Maybe a bit more in November. It's going to depend on the economic figures that come out between now and then.
Okay, thank you. Andy?
Yeah, positive news. As Paul says, we certainly weren't expecting that the early part of, or a week or so before the base rate decision. So the inflation news that came through was really positive. I would absolutely agree. I think, in terms of where next and what this does for the market, it's very much dependent on, a variety of different factors. And I guess what recent months has proven is that it is really hard to predict where the market is going to go. The early part of this year, we thought base rate was probably going to top out around about 4.25%. We then had the mid part of the year where inflation remained stubbornly high. Predictions were that base rate was probably going to be around about 6.25. And now we're at a point where inflation does appear to be coming under a degree of control, although early stages at the moment. And I think everyone is viewing that we may be nearing the top of that peak right now. I think it's good for the market. What you've seen is a flurry of activity since the announcement as well, with lenders repricing, which is a really positive sign.
Brilliant. So Andy, I want to just move on from the repricing point, and Matt, I'm going to come to you now if that's okay. So we have over a number of weeks now seen rates coming down. It seems like every day there's a lender coming out and there's rate adjustments. Do we think now we're going to continue to see that happen, or are we at a point actually where it's just lenders fighting for their share of the market?
Yeah, obviously it's still a very competitive market, and to the points already raised, it's a positive message yesterday with base being held at 5.25. The expectations during the start of the week was that it was going to move upwards.
Okay.
And obviously you see that reflected in lenders' pricing. Margins are still relatively tight for mortgages from a lending point of view, and you can calculate that by taking the swap. If you think of lenders pricing against term swaps, so the cost of the swap against the customer rate that's actually out there, you can actually see where that's tightening. But it is a competitive market, and lenders are keen to lend and support customers. What will we see going forward? It's only the first sort of pause in base. after, as Paul mentioned, 14 increases, and all eyes will be on November's next meeting, and obviously what inflation does between now and then. Competitive pricing pulling through is obviously a good thing for the customers because the market has been squeezed with challenges around affordability. But then there's other considerations as well from a lender's point of view, the increasing competitiveness of deposits. So it's an increasing cost with regards to deposits we hold, and also from a house price inflation perspective, if house prices were to dip slightly, that then increases the loan to value and increases the capital that we have to set aside. So there's a number of things that pull through, but generally you would see, and the expectation would be, as swaps start to react and start to reduce, then that should be shown in and reflected in customer rates.
Okay. Paul, so, I mean, in terms of where you now see the rest of this year, 2024, rates-wise, so you might have touched on it in terms of, we might see some slight moves down, but where do you see it from Santander perspective?
In terms of the market?
Well, in terms of rates-wise now.
Rate-wise, I think as Matt says, lenders' pricing is tagged to swap rates. So if we're looking at swaps, we can see 2 years is around 5.1, 5 years around 4.5. So you can expect to see rates 40 to 60 bips higher than that as the norm in the market. And I think we've got to see swap rates as a sort of forecast of what base rate's going to be in the future. And the prognosis of those rates is, a period of higher base rates. And so rates will follow that. I think there's an opportunity after the last few weeks that lenders will be able to price more competitively, and we'll definitely want the business.
Yeah.
So the element of competition that's appropriate and healthy is absolutely there. There's potentially some downside to rates of a minor nature, but I think customers probably get quite used to rates quite quickly when they have to make decisions about their life. And if there were a period of stability around prices, I think that might help customers make decisions.
Okay. So, I mean, while we're on the rate subject, Andy, I'll come to you if that's okay. We've talked about it in different things. It's been on LinkedIn a lot. Has been the pulling of rates, and it's a positive they're coming down, etc. But still, many lenders are sort of giving 48 hours. Where are you currently sitting? And do we feel 48 hours is enough time for a broker to be able to speak to the customer, sort things out, because things are about to change?
Yeah. So our position has been consistent throughout this past year. So typically, on the day of a rate withdrawal, we will provide a notification midway through the day, and you've got until the end of that day to submit a product reservation. I guess the difference for ourselves is that you don't need to submit a full mortgage application, so you can do a dip and reserve the product, and that's certainly, that level of consistency is something that we're keen to hold on to. The volatility in the market is clearly where we've seen, from a swap rate perspective, lenders withdrawing at short notice, and there's a combination of reasons that drive those short notice withdrawals. Historically, it's tended to be around operational capacity. So if you do a rate increase, you can naturally expect that your volumes for that day could be 2, 3, even 4 times higher than a typical day. And if you're doing that rate withdrawal because you're needing to maintain service, then it becomes a challenge. The second part of it, which has become more of a common feature in the current market, is the cost of funds, and swap rates being so volatile has meant that at times, lenders are underwater in terms of the products that they've got out there and the margins that they're able to make on those products. So there's always going to be a commercial element to any decision, and weighing that up with ensuring that customers can access those products. So we've tended to be consistent throughout, and I mean that's something that we'll certainly continue with.
Do we think that lenders are doing enough from an affordability perspective? Appreciate you have your limits, but Matt.
Yeah, so the overriding principle is that we have, as lenders, we have to lend responsibly. So we have to ensure that the mortgage is affordable to the customer now, and we're putting them in the best possible position for it to be affordable as they go forward on their journey of home ownership. What's been interesting, certainly over the last sort of 6 to 12 months, has been the ability to, I suppose, reset and look at policy and make sure that are we as a lender maximising the income that we will use. Again, keeping responsible, but also making sure that we're working closely with the broker partners so that they truly understand the income that we can use, and are there areas of policy that will help support them, because obviously there's different sources of income that come through. So we have made positive changes to policy this year, but it's something that we constantly look at, because affordability, with interest rates increasing, affordability has, there's been pressure on affordability, which obviously has, had an impact to confidence in actually purchasing.
The last bit I want to cover in this part, which is the whole PT. We've seen a big increase in product transfers. Are you concerned around advice that's being given, especially with the number that's obviously going direct as well? So, Paul, I'll come to you.
Well, we don't look to challenge broker advice on PTs. We're seeing a growing number of our PTs come from brokers, but it is still less than half of the PTs we get. There's 3 ways customers can transact with us on PTs, and it's via the various digital channels, whether that's banking or the website, over the telephone, where it's an advised process, or via broker for the same thing. And we do quite heavily signpost the route to speak to somebody if somebody does choose to come direct, and we do see customers moving from a digital to a telephone journey. So I think where a customer does want advice, it is available, and of course that's always available through a broker. Okay,
cool, fantastic, thank you, Paul. And
a similar position for Nationwide. So in terms of signposting, we make it very clear that the broker is there as the option. If that case originally came via the broker channel, I think in the current market, given the volatility that we've talked about, given where rates are bouncing around, given the dynamics have shifted, we're seeing much more use of trackers. We're seeing a bit of a flip from 2 years to 5 years. So it is a challenging market to navigate, and advice clearly is the best option for many. I think this is where it provides a fantastic opportunity for brokers, and this inevitably is going to be their differential as part of it. So we just try and ensure that we support brokers with the best possible system for submitting those cases and making all of those products available via that channel.
And I think also lenders have reacted to things we've had to deal with, like the mortgage charter, which has been very positive for consumers. And we've certainly made changes to our system to make it easier for brokers to give the best service to customers. And I know a lot of brokers are tracking rates as they come downwards, rewriting PTs. We've just made that doable electronically.
Okay.
And so, we see brokers as a great distribution channel for our existing customers, and long may that continue.
Fantastic.
Probably just worth adding as well that the positive changes to the product transfer proposition across the market has been the ability to actually secure rates earlier. So the brokers have obviously played a key role in doing that and monitoring that for their customers. Cool. To make sure that obviously the choice they make is appropriate for their circumstances.
Brilliant, fantastic. Well, thank you all. So that brings to a close part 1